Welcome back, everybody, to today's Market Explained, the FourStar podcast. I'm Brian Castle, your host. I'm here with Chris Reardon. Chris, welcome to the podcast.
Thanks, Brian. Glad to be here and glad to talk a little bit about the markets.
And Chris is the long-running regular co-host. Chris is the FourStar Director of Development at FourStar, master of all things portfolio. He still loves his Cleveland Indians, despite that they're actually doing better than the White Sox. That's for sure.
Mhm.
And Chris has got a big young family, and great job for FourStar. So welcome again, Chris, to the podcast.
Yeah, thanks, Brian. Glad to be here.
And I'm Brian Castle. As I said, I'm the founder and CEO of FourStar Wealth out of Chicago, headquartered out of Chicago. I'm an Eagle Scout, National Boy Scout Foundation trustee and philanthropic advisors to CEOs and insiders. I'm the chief dad to Quinn and Evan and husband to the amazing Tripty. So that's our story. If you like what we're doing, if you would please tell your friends, forward this podcast or email or a link to your friends, and then make sure you give us a 5 out of 5. That way our rankings go up in the system and we get more noticed. So today we're going to do our normal program. We're going to do markets, we're going to do the economy, and then what we see out there. So Chris, you usually give us the numbers on the different asset classes that are out there between the 6 major asset classes. What changes have we seen since our last episode?
Yeah, Brian. It's been relatively muted since our last podcast. We had a couple changes, but nothing too major, I should say. Domestic equities is still the number 1 position. It has 310 tally points, and it's +2 from the last podcast. So a little bit of strengthening in the domestic equities. International equities is still holding on to that number 2 position. It's at 267 tally points, and that's -3 from the last podcast. Commodities is in the number 3 position. It's at 253 tally points, and that's +1. And then the last 3 asset classes, so cash in number 4, it's at 117 tally points, and that's unchanged. Currencies is in 5th at 76 tally points, and that's unchanged. And then fixed income is in last or 6th place, and that's at 66 tally points, unchanged as well. So, still, it's been relatively muted, as I said. The only changes we really saw were from the top 3 asset classes, and for the most part, they were non-factors. We saw a couple point gains with domestic equities and commodities, and obviously international equities, a couple points decline, but nothing too major from that front.
Well, that's interesting, Chris. Well, thank you. So domestic equities are in charge, international commodities are real close third. So you can make a case that you can be in either one of those, second and third. But I don't think we've ever seen a report where the 3 scaredy cat asset classes, I call it, cash, bonds, and currencies, were unchanged, or any 3 were unchanged. So that's kind of interesting. So all the actions at the top of the risk level and the lower risk asset classes, not much going on.
Yeah, correct. Yeah, I mean, it's really interesting. I mean, fixed income being at 66 tally points is probably about the lowest I've seen an asset class from a tally point rankings perspective. That's pretty darn low. So it just might be to the point where they can't really lose much more. That'll remain to be seen. And I'm also kind of surprised that currencies is right there as well. I mean, it's at 76 too. So it's really kind of all the actions happening in those top 3 asset classes, and the bottom 3 really at this point. Cash is still kind of hanging in there. It's above 100, but for sure the bottom 2 have really just been kind of dead in the water.
Really interesting. So, but it is certainly a risk on market. So right now, for whatever reason, or we can think of some reasons, the markets are going higher. We're near highs. We've had a couple sloppy days recently because of some of the economic numbers, but we're still in that uptrend, essentially.
Yeah, no, I mean, definitely, we've gotten a little bit of momentum, if you will, in the last couple of weeks, and it's been really interesting. It's almost been kind of like a relay race. It's like been passing the totem because you had Nvidia kind of with a big run up, and then you had Oracle had another big run up, and then Apple had one. So you almost have kind of these dominoing tech names that are just kind of, kind of pushing the market forward.
I think so. Now we're in this kind of weird situation too, though, that Chris, last year was all about the tech stocks taking off and they outperformed everything. And then there was a wide divergence between the equal weighted index, which is like the average of all the stocks, and then the market average as calculated, which is market cap weighted, wide divergence. In the first quarter, however, that divergence went the other way, and the technology stocks didn't do as well. The Nasdaq was down relative to the S&P 500, but now this whole tech thing has turned around again, hasn't it? We're seeing Nvidia dominating everything. Chris, what do you see there?
Yep. Yeah, I mean, Nvidia's obviously been the big one that caught headlines. We've talked about it on this podcast. I mean, I think what we saw is, the big play behind it's been AI, and then AI certainly is obviously it's a huge kind of factor, if you will, that's impacting the markets. It's going to impact the world, obviously, I think. But I think considerations should be made as far as are the markets getting a little bit ahead of themselves? And Nvidia's the run it has had has been kind of incredible in some ways and just fantastical, I would say. Just the amount of market cap, the amount of that the stock has gained. So it's pretty crazy, but I think there is. I don't want to say legs there. There is some underneath structure as far as that, like the AI component, because just like the power needed, and we've seen kind of shifting on that front for some more power needs because of the needs that are going to be required for AI. But you also have these semiconductor chips, and you have companies like Oracle and companies like Apple that can leverage AI and kind of use that in their tools. So there are definitely some productivity advances. There's definitely some technological advances with this, but with the run the market's had and these stocks have had, I mean, I think considerations have to be made as far as, are we getting a little bit of ahead of our skis here? But, maybe we're not. We don't know. Only time will tell.
Yeah, exactly. Well, okay, so just looking at the stats on Nvidia, the biggest name in the market now, split 10 for 1. So they started this week in near $111 a share, and starting this week at 21% of the S&P return. So of the entire 500 index, 21% of the return of the S&P 500 is just from one stock, Nvidia. And that's up huge. And the S&P was up 12.1% starting this week. It's up a little more this week. So that means 2.5% of the overall return of the index was from Nvidia alone. Pretty amazing.
Mm-hmm. Yeah,
And,
no, I mean, it's big driver there.
and then the equal weight index, which we mentioned from last year, was up a lot less than the standard, the S&P 500. That's only up starting this week at 4.78, and the S&P up 14.2. So again, like a 10-point divergence between the average stock and the index. So that means you want to own the index, but then when does it go the other way like it did the first quarter? So you got to be really careful. Index gets very whippy because it's got these high octane names that dominate in the market cap.
Yeah, no, for sure. I think one interesting statistic that I found was 70.4% of stocks in the Russell 3000, which is kind of considered the entire stock market. It's obviously not just 500 names, it's 3000. So 70.4% of stocks in the Russell 3000 are still below their 2021 highs. So that means only 30% of stocks are, we're at reaching new highs. Obviously, the markets continue to propel forward, but it's only 30% of the stocks, which is kind of crazy to think about. That 70%, this big foundation of stocks, probably the small caps, the mid caps, are either flat or moving down. So, it kind of gives a good perspective on the market. And then even more to kind of what you were talking about, Brian, year to date for 2024, only 30% of the S&P 500 stocks have outperformed the S&P 500. And that 30% is only slightly higher than the number we saw in 2023, which was another year where you saw, as you mentioned, Brian, the Magnificent Seven, these high momentum stocks driving the stock market. And one interesting thing this harkens back to is the last time we saw such a low number of stocks that outperformed the S&P 500, in consecutive years was actually, you have to go all the way back to 1999 in the dot-com bubble. So not to say that this market will have the same impact. It could not. But it's an interesting thing to think about, kind of the mania that's going on regarding this AI and everything. Obviously the dot-com bubble was around internet. And I mean, internet itself is obviously a very, very important part of our society. It was revolutionary. You can't discount that. But the euphoria that happened around the dot-com bubble just almost got, as I said before, we got ahead of our skis, kind of. So are we seeing that here? Are we not? It'll be interesting
Yeah,
to see how it plays out.
it will be. Yeah, and then just by way of understanding, in 2023 we mentioned that the equal weight was up 10.8%, but the S&P 500 market cap weight was up 24. But then in 2022, when we had the worst investing year that I can remember, the S&P 500 was down 19.6, but the equal weight was only down 13. So the volatility of those technology stocks either swings the index higher than the average stock or lower than the average stock. So it's a very, very volatile game. So the question you have to ask yourself is, the S&P actually a little bit of a speculative index at this point? And I think the answer might have to be yes, because the
Yeah, I
average
mean,
done much different than the index.
I would 100% agree, Brian. I mean, I think it's become, and it's always been, but it's been skewed so much more as of late. It's a speculative momentum-based index, right? And it's only just gotten more, that's only been fed into more in the last couple of years, I would say.
Exactly. So be careful out there. As always say, we are in a rising market, but if you're going to play those technology names, be careful, watch your allocation. If you want to load up and do a lot of good in a wild tech market, fine, but be very careful and hit the exits right away. The problem is it's so hard to know when. And so we have a system that we track to know, when we take certain amounts of risk off the table, and then we manage. And managing risk is the most important thing in investing in stocks. So,
Yeah, no, for sure.
so that's where we are so far with the market. This past period, since the last podcast, we had a resurgence of the meme stocks. Anyone who saw the movie Dumb Money saw Keith, forget his last name, the Roaring Kitty. Roaring Kitty was on YouTube for the first time since 2021, and he had 440,000 people watching him. And he gave the GameStop stock a good day. And Chris, was so good, in fact, the GameStop company came out and sold stock, didn't they?
Yeah, so I mean, well, actually, the day that he streamed, GameStop was actually down. It was down even leading into it. But it ended up being down. I think the day he streamed, down 40%. It was still up relative to where it was, a month ago. So it still was elevated, if you will, but it definitely kind of pulled back. I think a lot of people were expecting it to be like $65, which was quite frankly actually ridiculous. But it actually came back to more closer to reality in the $20, I believe, per share. But yeah, GameStop is really taking advantage of it, this mania going on, and still selling at the elevated price. Even $23 is elevated from where it has been months ago. So they raised 2.14 billion by doing a kind of spot stock sale. So they're certainly taking advantage of the attention that they're getting back, the renewed spotlight from Roaring Kitty and all the meme stock followers.
Yeah, says that's always an interesting development. And also, since we last met, the Apple common stock has become the largest stock in the market now, and they've continued to grow. And then this week, the Apple artificial intelligence announcements this week. They're at a developer conference, including artificial intelligence, and they're now going to build artificial intelligence, excuse me, AI into all the phones. So then you'll be able to try things out. You want AI to write you a letter, draft a response. It'll also kind of watch what you're doing, and if you're not productive at a certain hour in the day, it can see patterns and tell you what's going on. And intelligence can tell you everything. So I think we have to be careful with this stuff, because you're never quite sure what accuracy it's getting. But some of it is pretty accurate, and some of the writing isn't always that accurate. But nonetheless, It's a new development, and everybody's going to have that in their phones. So that's what's going on in the market. Chris, let's turn to the economy. We had the CPI come out. Give us some
Yep.
info on that.
Yeah, so we had this week we had the CPI come out. It was at 3.3% year over year. That was down 0.1% from the April read of 3.4%. And that was slightly under expectations. The core CPI was at 3.4%, down from 3.6 in April. So, a lot of people looked at the market, and we've talked about this, why do we even quote CPI? Why is it important? Well, obviously it's measuring inflation. The more inflation gets closer to that 2% number, which is the Fed's target, the more likely that the Fed will lower interest rates. So that's why the market is really tracking this quite closely and very sensitive to it. And so the market's read off of this top of the line number, the front page number, if you will, was that CPI continues to come down, albeit it's still very slow, and it's still elevated. I mean, it's still 1.3%. Above on just the base level, and 1.4% on the core side. So there still is some stickiness, I think, on the CPI and on the inflation level that still remains in the system. And I think with that, the Fed's most likely not going to be in any hurry to lower interest rates. And then the next kind of big news that came out was the employers came out and added 272,000 new jobs in May. That was, and this once again is the headline number. I was well above expectations, which were in the 190,000 mark. But one thing I think that's important to point out with this is these are kind of adjusted numbers, so they try to adjust these for cyclical, holiday hiring, things like that. So, these numbers aren't necessarily pure numbers. I wouldn't say there is a equation. There's a formula to them. So it's not always necessarily the most, I don't say truthfulness, but it's not necessarily pure from that standpoint. So, that's really interesting. And I think the important thing to read from it is, what the market read, which is that the economy is still very strong, is what the market read, and inflation is coming down. So you have kind of we've talked about the tug and pull going on right now. In one category, you have the market reading that inflation is coming down. So the Fed is going to lower interest rates sooner. And the other camp, from the headline number perspective, once again, that the economy is strong and that the Fed is not going to raise or lower interest rates anytime soon, because why would they lower interest rates if the economy is strong? So just a lot of confusion, I guess you could say, when you really kind of dig into it a little bit. And then when you look at it, the biggest upticks from that employment number were from government, leisure and hospitality, and professional and business activity. So, and the other, to add a little bit more even confusion to it, the unemployment rate actually edged upwards, which came out the same day as so we had this big jobs number and employment rate edging up. So, it's interesting, some of the economic numbers and the impact it has on the market right now, because it's so sensitive to what the Federal Reserve will do with interest rates right now, factored in for kind of the fall / holiday season.
Yes. Well, taking that to another level too, Chris, the establishment survey was up to 72,000, way above expectations, but the household survey, which is another considered to be actually more accurate survey, only counts every job holder once. So even if you got 3 part-time jobs, they don't count 3 jobs, they count one employed person. That survey was down 400,000 jobs, right? So we have this wide divergence between the two. And for the last couple of years, there's been some concern that we're not getting accurate numbers from the government from that establishment survey. And so many people have kind of postulated that that's true. Then what we've seen is every year for the last 3 years, we've seen job numbers coming out, and there's a big gap between the surveys. Then the establishment survey revises things down, but they've never revised up, right? So if you're actually a statistics expert, you'd realize that there may be some inaccuracies. But if there were inaccuracies that were fair, they probably wouldn't all be down. Maybe some revisions would be upward. So the fact that the revisions are always downward makes people believe that they're being inflated. So That was always the unsaid thing by the government, but now even Chairman Powell from the Fed said today that there may be some discrepancies in some of those numbers. And so they're concerned about the numbers. So the bottom line is, while, we expect to see the 272,000 revised downward, why do they always come out with numbers like that? The jobs front is not as good as it appears. And so this is political season. So there are people that have an interest in making sure that the survey sounds better than maybe it is. And so when they get a number like that, they come out with it and then they tout it, like, as you said, like everything's fine. The reality is much different than that. We talked about the inflation rate, went down to 3.3. And so then some are touting, well, it's going down, but it's way above normal. The Fed's target is 2%. And the 3.3% by current calculation is 3.3, but by the method they used in the 70s, that would be closer to like 8 or 9%. So inflation is still high historically. They changed the method of calculation to mute the number a little bit. And so all that means is that 3.3% higher than last year. So every year it keeps going up, and Americans are not keeping pace with inflation. It is admittedly down from where it was in 2021 or 2022 in the summer, but it's still high, still elevated. And the reason is not personal spending and it's not business spending, it's government spending. So we continue to have government out of control. One of the largest job growth in that survey was government jobs. Second was healthcare. So we still continue to spend so much money at the government. There are some things that we're looking at that make it clear to us that things are slowing down. The number of people who are unemployed 27 weeks or longer is rising. So unemployment is going up. The number of people unemployed for more than 27 weeks is rising. The labor force participation rate of all the people who are eligible to work, how many are working? That's all able-bodied Americans above 18 years of age. I think up to the retirement age. Labor force participation rate is 62.5%, but 252 people left the labor force. So the labor force itself is going down as people are getting discouraged. Employment to population is lower. And we mentioned all the differences in the job surveys. So there's a lot of confusing things coming down. One of the things that also had been noted is that the inflation for the last couple of years is still substantially up. So in the short run, while we're in political season and people are trying to say, well, inflation is going down, it's getting better. But since the current administration came in, the average cost of rent is up 21% nationwide. Real estate prices, food prices are higher. And then this is an interesting statistic we just saw from Zillow. According to Zillow, in 2020, the average income needed to qualify for home ownership was $59,000 of income. You could qualify for a basic level home. Now you need $106,000. So only six-figure earners can buy a home. So that's all changed. The average cost to maintain a home is up $18,000 over the last 2 years, 26% higher than before. That's for maintenance and cable and insurance and all the things you need to run a house. So inflation is up, but our incomes are not up as much. So it's really crimping what folks can do. So the economy is clearly pulling backward. The question, of course, is how bad does it get? With the market rising here, and generally in an uptrend, then the question is, well, is the market already anticipating a recovery? Will this downturn be more muted and end sometime in the next month or two in the economy? Or is the economy going to get worse enough that the market stops going up and starts going back down? So we'll see. The market tends to be a discounting mechanism before events happen. So always think that market's signaling what's going to happen in 6 months. So the market is saying the economy will recover in the fall. We'll see, Chris. We'll see if that plays out.
Okay. Well, and I think that what markets are saying is essentially that Powell is going to relent and lower interest rates in the fall, and then that's going to help the economy recover because we're going to see lower interest rates, and then you'll have companies spending again and hiring and everything. So, what could throw a wrench in that is, as we've talked about on this, is if inflation stays high. If something forces the Fed to not lower interest rates in the fall. I think they came out and said that they anticipate a 1 interest rate cut this year. is what they're anticipating. So if they don't, lower interest rates this year, what does that factor? And what happens if they have to raise interest rates, which we've mentioned on here, if inflation reaccelerates? So there's a lot of factors out there, as Brian, as you said. But right now, I think the market is factoring in, I think a September or fall rate cut.
And that's
So,
what there's, so Chris, the Fed came out and they really tamped down people's expectations just by way of review. We came into this year and there was talk of as many as 6 interest rate cuts. Then that number went from 6 down to 3. And then they say higher for longer in interest rates. And then they said, well, maybe one in March, maybe one in June, maybe one in September. Well, then March went away. They're saying June. Well, we're not doing June anymore. That came and went. So they're saying now they're looking for maybe 1 rate cut this year and 2 or 3 next year. But we'll see if that holds, right? We're not sure.
yeah, no, I mean, I think, like you said, there's unknown factors there as far as inflation. So it's not a given, I would say.
And then the other, and this before in other episodes of the podcast, that if inflation does take off and whether the economy recovers or not, inflation could hurt the economy. But if inflation starts to go higher from this level, and it's been higher the last 4 months, so now it's just basically flat for May. But if it goes higher, then maybe we'll have to actually see interest rates not only not go down, but go up. And that's the fear. That's what happened in the late 70s, early 80s. And we saw inflation explode. And then we saw interest rates go very, very high and up until the highest Fed funds rate in American history at 16.9% in September of 1981. So we'll see if that plays out the same way. Hopefully not. That would be bad for the economy. That would be bad for our pocketbooks and everything else. But we'll see what happens. But Chris, there's a lot of international stories as well in the economy.
Yeah, so yeah, a lot happened from the international front. Kind of the primary, the European Union became the second major global economy to cut its benchmark lending rate. It cut it 0.25% to 3.75 from 4%. This was widely expected. This was, I would say really highlighted. There was some questioning kind of a month out, but as soon as kind of some of the economic numbers really cemented in as it led up to it, I think it was almost, guaranteed that they were going to, lower it 0.25%. So, they became the second economy to lower. On that front, we saw a bunch of international elections the last couple of weeks. Mexico elected their first woman president. So we've seen a little bit of chaos within the markets within Mexico, just as, questioning on whether the new president is going to continue the agenda of the old, things along those lines. And then in India, Modi, who was hoping to sweep the elections and have his party kind of consolidate power, was able to win, another year, another term, but his party did not gain as many seats or support as they anticipated. So originally, I think this was seen as a negative because, Modi has really pushed for a reform within the India economy and really try to make it more transparent and more better for business. So people thought that this would be an encumbrance to that, but I think, as the markets have digested a little bit more, now people are kind of saying, well, it's moderate a little bit more, so maybe that will help kind of moderate things out. So interesting there. And then in the European Union, we saw a large shift. So we had parliamentary elections this past week, and we saw a huge sweep with what are considered center to kind of center right leaning parties within the EU, within France, Germany, Italy already has it kind of there. So, but Spain, I mean, all across we saw kind of a shift away. So, that's really interesting. And I guess people don't really think about it this way, but, what's been in place, you had the Paris Climate Change Accord, all this going on as far as climate change. But then you look at the last couple of years, and especially the impact Europe has had because of the Russia-Ukraine war going on, the prices of oil, energy, things like that. Now you've seen the populations, the public, kind of get fed up, especially with inflation driving things higher. And so you're seeing kind of a more of a shift, a popular shift there, away from kind of green energy and these sources, and more towards kind of a middle ground. from an economic front. So kind of really interesting. And we are seeing that, I would say, in the US, I think, too, to a degree. So it's really interesting from that front. And then a couple other quick things. The EU is expected to impose tariffs of up to 38.1% on imported Chinese electric cars. So we continue to see, international countries kind of impose tariffs and restrictions on China, especially when it comes to trade. And this comes right after, about a month after, a little less, Washington or the U.S. Increased tariffs on Chinese EVs electric vehicles by 100%. So, pretty crazy. And then the last thing I will note is German manufacturing orders. They unexpectedly fell 0.2% in April from March. That was a very stark contrast to the expectation, which was a 0.6% rise. So, they saw key misses in April in aircraft, trains, and ships build parts for that. That dipped about 15%. And then Germany's key auto industry saw a decrease in 4.1%. So, really a lot going on, I would say, on that international front.
Yes. Well, and just to add to that international discussion, there's been a huge shift, Chris, in the EU. Now, America had continued to be the strongest economy in the world, but in many of the other areas of the world, it slowed down sooner than we did. So the European Union, as you mentioned, they had to raise rates finally because things had recessed, or I'm sorry, lower rates because the economy had recessed to the point that they needed to stimulate the economy, and inflation for them was somewhat under control. But now we're seeing that they're not doing well economically and having to lower rates. So there's been a huge shift now in political trends in Europe. Europe had long been known as a very liberal area. Lots of migration, lots of big government spending, big government policies. There's been a huge shift toward more capitalistic type opportunities rather than socialistic. And so the conservative trend has started: less green energy, lower taxes, lower migration. That's kind of very capitalistic, positive, conservative style. In Italy, they elected a new conservative, capitalistic prime minister. In the Netherlands a few years ago, Hungary, of course, and now France. So in France, Macron's party did not get enough votes to seat a government, so they need to now call a new election. And so we'll see what happens there. And of course, the both sides kind of beat each other up and say they're too far right wing and they're too liberal and all that. But the trend is definitely on the side of capitalism and conservative views on making the economy grow and giving self-reliance rather than government spending. So that's kind of where the trends are now. We're seeing a little bit of that in the polls leading up to the American election as well, where we've had very high government spending, very liberal policies in the last few years, and the polls are showing it's going back in the other direction. So we'll see what things look like in the fall. Chris, you also had looked into electric vehicles.
Yeah, so as I had mentioned, within the EU, the electric vehicles, the Chinese electric market, we're continuing to see tariffs be imposed, with the EU now imposing a 38.1%, the US less than a month ago, 100%. That's good to a degree. I mean, I think we talked about it on this podcast, how the Chinese subsidize a lot of their companies and can really drive that price lower to bankrupt other companies and kind of control the market. So obviously we don't want that to happen. But on the negative side, if you have cheap goods coming from China, I mean, that's in many ways what powered the economy coming up to really, for the early part of the 2000s right now, was cheap Chinese goods. So, that's the impact that could have on inflation here. Obviously EVs, electric vehicles, is certainly a niche. But as more tariffs get enacted, I mean, it's definitely going to increase costs in the U.S. I mean, that's what tariffs are there to do, to offset, these cheap goods.
Absolutely. Well, so there we are. Hollywood is going through a depression. New films year over year are down 50%. There's layoffs everywhere. Disney and Paramount, all the big studios are down big. In fact, a good sign that things are changing in Hollywood, or certainly things are dire in Hollywood, is that faith-based films, which were always considered to be, kind of a fringe element. Well, now they're actually embracing faith-based films, which studios hadn't done in years. They always had to be done by religious groups and other areas. But now main Hollywood is getting involved because they need some films to make. So I thought that was an interesting trend. Walmart and others are closing stores and laying off employees. Target is slowing down as well. So we're seeing a lot of concern. The famous strategist Dave Rosenberg, for many years was the lead strategist at Merrill Lynch. Now he's Rosenberg Economics. He's very cautious on this year. Last year growth was 3%. This year we're going to go down to 1.3. We may go negative and have an official recession. But the good news in his mind is inflation is slowing, and it is slowing. But I hope he is right on that it continues. And now the lower inflation, he thinks that things will go back. Eventually, they will lower rates, and that projection that the Fed had, that's further out now, but will still play out that way, and we won't have the big spike in inflation and rising interest rates like I had said were possible. So on the other hand, looking at California is our biggest state, and the business owners of the state of California called out the governor for raising the minimum wage. He pushed to raise the minimum wage to $20. They took out a full-page ad on the USA Today. They've announced across the state at least 10,000 layoffs, and including 1,200 layoffs of Pizza Hut delivery people. Pizza Hut just got out of the delivery business because of the minimum wage of 20, and the way the bill was drafted, they can't afford to have those. So no more delivery of pizzas in California from Pizza Hut because of the new minimum wage. So the complaint about minimum wage is that it causes unemployment. It hurts the very people it's intended to help. So you may give some people more wage, but you give less people a job. And that's certainly playing out that way very, very clearly in California. California also leads the nation in out-migration. Apartments now for California homeless are featuring high-end amenities as the government continues to way overspend, and they have a $45 billion budget deficit that they haven't solved in California. So to watch capitalism decline in California is very, very sad, but the people are voting with their feet, and they're also leaving large states like Illinois, our home state, FourStar headquarters, and then also New York State as well. So the big states with big budget deficits and big government spending are struggling, and the more capitalistic states are doing better within America, and that's happening around the world as well. So the capitalism, freedom agenda is working, and those who are adopting it are doing better, and those who are not doing that well. So anyway, that's our wrap up on the economy. Anything else you have, Chris?
Yeah, the last little tidbit that I have, I thought this was kind of interesting, kind of ending on West Texas Intermediate, which is kind of the, on the commodity front, oil front. That's kind of the proxy for United States oil. Last year, it was added to the Brent benchmark, which Brent crude oil, you probably heard that name before. That's kind of considered the global oil price. So West Texas Intermediate was added last year, and in that year, it has been the most dominant grade in the Brent basket. So it encompasses about 57% of the benchmark. And since its inclusion last May, the volatility has fell 0.5%. So, one, as you kind of alluded to, capitalism, you have these American oil companies that are, we have fracking, they're pumping oil, they're exporting oil. We're seeing that oil have an impact on the global markets. It's bringing oil prices down a little bit, slightly. So it's interesting to see how the a U.S. industry such as oil can have an impact. And you go back 20 years ago and we weren't exporting oil. And now, we can have such an impact on the global oil market.
Yeah. Interesting. Well, and then what we see out there, Chris, on a positive note, if anybody's been following the saga of the city of Detroit over the last 40 years, they topped out really in the 1970s and early 1980s, and it's been downhill ever since, all the way until most people feel that the bottom of Detroit was about 2000 to 2001. And then ever since then, it's been slowly coming back to life. Well, now it's 23 years later since the bottom, and Detroit's making a resurgence. There are people moving back to Detroit. Downtown has been growing, lots of new buildings being rebuilt. Some companies have been moved into downtown Detroit. And actually, Ford Motor, they revived the Michigan Central major train station, which had long since been closed. And it was a classic sign of the decay of Detroit. It's a beautiful building that looked in very, very bad shape. And so they have revived the Michigan Central Station, made it an event venue. And so now people can go there and have parties and weddings and other things in the former train station. And it's a sign of the revival of Detroit instead of the decline of Detroit. And so some of the neighborhoods that were closed are being reopened. They actually had closed neighborhoods and turned off utilities to some neighborhoods because they didn't want to spend the infrastructure on it and the upkeep. So now they're coming back to that. So good work for Detroit. Good news for Detroit. And so that's a good thing to see. And eventually, all things bottom and will recover, and then capitalism will cause that recovery. So anyway, that's a good news, Chris. So.
Yeah, no, very good news. It's good to see.
And then we're just about done for the day. I just want to remind everybody that the Leadership Matrix, which is the main blog post for FourStar Wealth, is on our FourStar site, along with the other blog posts of our different advisors, the Collar Stocks, the two other podcasts or two other blog posts as well. Leadership Matrix has a bunch of different articles about things that are happening in the economy. And so hop on there and get on, give us your email and you'll get a copy of all those blog posts. We're also planning a number of interviews on the Today's Market Explained, so watch for those. Chris and I will be back in about 2 weeks. We're going to be down in Mexico at the firm's summer conference, and we might do a little podcast work from down there, Chris. How about that?
Yeah, we'll see. Yeah.
So anyway, that's all for now, folks. Thanks for being with us again on today's episode of Today's Market Explained from your host and co-host, Brian Castle, Christopher Reardon. We are signing off for today. Over and out. We'll be back soon. Thanks, everybody.